All right. Hello, everybody. Welcome back to another Market Open. It is August 8th, 2023 at 9:21 a.m. It is the day after Palantir's Q2 2023 earnings. We have got a lot to talk about and a lot to discuss. On top of that, we got Beyond Meat earnings. We have Novavax. There's a pharmaceutical company, ticker symbol NVAX earnings. We have Moodys, which is another credit rating agency in the United States that has decided to cut ratings of 10 different U.S. banks due to fears of credit tightening and commercial real estate exposure. And that is what has tanked a lot of the market this morning. Very red, especially banks are red. And on top of that, you got Philadelphia Fed President Patrick Harker, who suggests that interest rate hikes are coming to an end, and you've got inflation coming in a couple of days. This is going to be one of the most monumental weeks for the summer, definitely in terms of determining the trajectory for where the market's going. And so we have a lot to discuss and a lot to get going on. Thank you all for being here. Kevin Smith, Power Napster, Michael R. Angelo, Jay Berg, Mike, David, Larmo, Benny, Dan Harkless, Felicia, Sanjay, Broccoli Bob, Julio, Mr. Russo, Investor UK. Thank you all for being here. Attack, attack, attack in the words. Scarp, Ray, Rocco, Anthony, Jew Jr., Lenny, Kunal. Thank you all for being here. Ryan, Tesla Bull, Anthony. All right, there we go. So I want to start off with Palantir earnings and do a little bit of a recap of what I saw. I will be coming out with a video that does a much more in-depth explanation for what I see on Palantir earnings. But one of the most interesting things that I saw, and I think that all of us saw, right now we're down about 2.28% in the pre-market. The expectations going into earnings was that if Palantir does not deliver a massive beat, the AI premium that the market has rewarded them for their lackluster growth, which we can all agree, 13 to 17% growth is just not the type of growth you need to be commanding the types of multiples they're getting on their stock in terms of a price of sales of 19. We thought they would tank. I mean, pretty much everyone, the analysts from Wall Street, retail, I've talked to many of retail investors in the community as well. We all thought, look, the stock's going to sell off. I mean, we just can't justify. We were all mentally prepared because in our heads, we were like, we love Palantir. We understand the company. We understand it's ahead of its time, but we know that the market, we can't control the market. We know the market's not going to let it survive if it barely grows. Like, this is a tough, ruthless, competitive market with interest rates at 5.25. However, that's not what happened. That is not what happened. The market decided to drop it about 10% to around $15.80 for like 3 seconds. And then it went all the way back up, turning green yesterday at around 1843. It's red right now in the pre-market because, as you can see on the left-hand side of my screen, everything is red right now. Datadog, by the way, as well, which is an interesting thing we have to talk about. They are also a SaaS company. They're down 20% after their earnings. Palantir was up 3% after their earnings. Datadog, I believe, is growing more than Palantir. It's at a $34 billion market cap, so it's actually, relatively the same in terms of valuation of Palantir. Their price to sales is 18, ours is 19. So all of the metrics are kind of the same. I believe they're growing more. They reduced guidance slightly. Palantir raised guidance slightly, and maybe that was the differentiating factor for Palantir staying afloat and Datadog crashing 20%, or maybe Wall Street just knows something about Palantir that they have finally figured out, and they're excited to give it the premium. Either way, the premium given to Palantir, and I don't know what the price action is going to be like today, but we were expecting $14 this morning, right? $13 last night. That did not happen. That did not happen. And I cannot be more happier doesn't make sense grammatically, but you get my point, as a shareholder to see this type of price action. Now, would I want it at $8 again? 100%, because I would love to buy the dip there. But in terms of just pure price action, the market, for some reason, has understood Palantir and has not destroyed it right now. A couple quick things on some stats, and then we'll get into some other things. I think the biggest thing, takeaway from Palantir, and again, I'll have a video coming out a little bit later on discussing more in depth, customer count is up, and there are over 300 organizations that are in the pilot phase for AIP as per CARP's shareholder letter, 100 of them already using AIP, and those 300 are additional. So think of about 400 different customers in talks to engage with AIP. That means that revenue acceleration and massive adoption of enterprise AI platforms, which Palantir will have insane levels of pricing power over because they did not price the product, because they don't want to price the product, because they believe it will be infinitely valuable versus stamping a $2 million price tag on it, is going to pay dividends in the future and going to show accelerated growth. And I think Wall Street's kind of counting that. Look, if customer count is re-accelerating, it was at 6.5% last quarter, now it's at 8%. We gained 31 new customers. Those customers are engaging with AIP. early inning stages, and maybe you could argue that they don't deserve to be at the share price. But Wall Street thinks, no, there's momentum there. It's coming. AI stocks we need exposure to. Palantir has 400 clients using their AI platform. Eventually, they will monetize that. And when they monetize that, that will be likely very good for the company and show massive levels of revenue growth, which should be able to enhance the company, the stock price, etc. So revenue was a beat. EPS gap profitability. We raised guidance slightly in terms of adjusted income from operations and full year revenue. But what really mattered was customer count to me, and the enthusiasm by Alex Karp on the earnings call saying that we're going to be okay, and that AI, and that he believes that the AI platform is going to affect many parts of the industry. So that's ultimately what I got from the earnings call, and that's what I liked the most. Should we buy below 17? It's hard to answer that question. I would wait a little bit and see what's going on with the street and the macro. The only reason I'm saying that is because we're getting a ton of macro news that's not the best. So this news today kind of shocked the entire market, and that's why I think Palantir truly is red this morning, along with every other stock. Moody's is a credit agency. Remember Fitch? Remember those wannabe Abercrombie and Fitch people who downgraded the United States and basically sent the markets into turmoil for like a day and a half, or honestly like an hour and a half? Moody's is another credit rating agency, and they've cut the ratings of 10 U.S. banks and put some big names on downgrade watch. This includes Northern Trust, Truist, Bank of New York Mellon, U.S. Bancorp, State Street, Cullen, Frost Bank, a bunch of these different things. Now, what is their argument? Their argument is U.S. banks continue to contend with interest rates and asset liability management risks with implications for liquidity and capital as the wind down of unconventional monetary policy drains system-wide deposits, and higher interest rates depress the value of fixed rate assets. Basically, the basic bear case you could give to regional banks or to any banks in general, that's what Moodys said. And so the downgrade is really weird. I asked our good friend Chris about it, and his argument was a lot of the regionals are actually insulated against credit risk, and Moody's is being cautious right now. So he says this is the best part about regionals. They've already drawn down significantly and have already firewalled their balance sheets. So Moody's is using a lot of old data to make these new decisions, and this is where the Fed gets mad, and they're probably yelling and cursing because they're so annoyed that this credit rating agency is using a ton of old data. Like their argument around regional banks that I just said right now is old. And by the way, it was a good argument, and that's why regional banks are down 30, 40, 50% on average. So regional banks are already down, and so as a result of regional banks already being down, that's why it's not necessarily going to be the biggest impact on regional banks. I mean, do we see Truist at $23 that's paying an 8% dividend? Do we really see that happening? I don't know. And so the regional bank downgrade, although it has stocks down this morning, I don't know if it's down, if it's enough to significantly cause a contagion and spiral in the U.S. equity markets when it comes to banks. S&P at 447 in the pre-markets. We got Tesla 247. The CFO leaving, I guess, was a big deal for some reason. Some people are saying, oh no, he's made 40 million bucks, so he's leaving. Other people are saying him and Elon hated each other. I don't know what the answer to that question is. But I do know that the street did not like that Zach, the CFO, left. Enphase down at 133.99 cents. Open Doors down. Fubo's down. We've definitely seen a rotation. We got the market open in about 50 seconds from small and mid cap to large cap. Now, today, no one is safe. Look, even Amazon's down. Meta's down. Google's down. Microsoft's down. So a lot of the small cap is getting hammered today along with large tech cap. And again, I think that large tech cap is mainly because of the regional bank downgrade. So that's causing a shockwave through the entire equity markets. However, yesterday it was very obvious. Robinhood, SoFi, Palantir, even though Palantir recovered after hours, those stocks left some of their market valuation, and it was given to Meta, Google, and Microsoft. And so it seems like the market's gearing up for a little bit of a correction that we may be having due to a couple other macro factors. After the market open, I'm gonna discuss what may be the factors for a potential recession in the United States, or at least a potential pullback over the next couple months, and hopefully ending the year out strong at around 4,800 on the S&P, which is Tom Lee's bull case. All right, here we go. 8/8/2023, August 8th, 9:30 a.m. Thank you all so much for being here the day after Palantir earnings. Let's see what happens. The stock market is now open. Wake your ass up if your ass is not up so far. Here we go. Palantir down 5%, $17.14. Let's see how badly the market takes it. Do we fall below 16? Do we fall even lower than that? Or do we sustain ourselves over 17? The volume is 8 million shares within a couple of minutes or a couple of seconds of the market opening. So we probably have some from the pre-market. $17.08 down. 5%. Google at 131, down 0.4%. S&P 500, 448, down 0.6%. Tesla, 248, down 1.21%. Enphase at 134, actually recovering a little bit from the pre-market decline of 132. Open Door at $3.03. They were gap profitable, but they sold 50% less homes than they did in the previous quarter. And so that's why the market is bringing them down. Still up almost 240% for the year. Fubo, $2.50, down 2.69%. NASDAQ, 13,800. We are seeing 13,800 in a long time. We've been hovering from 13,009 to 14,004 for the past 2 weeks. So we are seeing an actual, drawdown a little bit, at least in the NASDAQ, down 0.85%, going down to 13,008. Apple, this one has just been insane to see. Apple was $198. Most banks upgraded it to about $240. After that earnings, even though they have $100 billion of cash on the balance sheet, they printed $81 billion of revenue. The street was like, look, you're not growing. And if you're not growing in the sectors we want to see you grow, we're not giving you the valuation. This may be a really big buy the dip opportunity for some institutionals that have been waiting to get back into Apple below a $3 trillion market cap, or it may be a sign that Apple really needs to show more product growth before they can show services growth, which is what they're banking the company on right now. SoFi at $9.11, giving up all of its gains, if not more, from its earnings pop. So SoFi popped to 11.70. Now it's at $9.10. Look, I think this is a good thing, to be honest. 11.70 was a bit unsustainable for SoFi, especially given some of the macro. That's okay. Holding up at $9 is what matters to me, right? Remember, the stock was at $4.70 in May. It is up more than 100% at $9.12. Would I love it to be at $11.70? Yes. Do I think the earnings absolutely killed it and justifies it to be a $12, $13, at least $15 stock? Yes. Did every price target come out upgrading it to $15? Yes. It'll happen in due time. It doesn't need to happen now. It's going to happen. The team will be executing. I have full confidence in Anthony Noto. Gap profitability is likely around the corner. And so when SoFi gets it, they're going to be able to sustain it. But in this macro, probably a little bit harder for them to sustain it right now, especially when some of the large cap tech is down. Uber at $44. I've never owned Uber, never wanted to own Uber. I don't care that they're gap profitable. I know there's so many bulls on Twitter around Uber. I don't get it. You're paying $90 billion for this guy. It's like, look, maybe the long-term trajectory is cool, but $90 billion for this company is a little bit much for me, given it's the ride hailing market. Like, that's just not an exciting future to me, but maybe I could be getting Uber wrong. Amazon at $140, Neo at $13.90, Meta at $317. Meta, one of the only green stocks in the market today. Robinhood, $11.07. Robinhood continuing to get hammered. Cathie Wood bought an additional 481,000 shares of Robinhood on Friday. That comes after 451,000 shares. So she picked up about 900,000 shares last week from Robinhood. Shopify getting hammered as well. $56, down 1.5%. Rubicon Technologies, this one is down 5%. It rallied heavily from about 50 cents over the past couple of weeks, but it's down a little bit today. CVS is down. C3AI is down 3%. Where is Palantir? All right, Palantir is 7% down, 1671. We're seeing some volatility here. I still think this is okay. Even at $15, Palantir maintaining itself. You got to remember it was at $7 a couple of months ago. So for it to still consolidate in this range and not go all the way back to 10, that to me is a positive sign. We'll see where the market takes it. Maybe there are some people ready to buy the dip, or maybe retail gets in a friendly and sells off the stock. 15 million in volume right now, down 6.25% on a pretty bloody day for the entire market. JP Morgan is down, Bank of America is down. Let's go to Truist. It was included in that downgrade from Moodys. Truist also down 4% on the day. And then PayPal is just like not getting any love by the market at all. PayPal, $63.77, down 11% after earnings. PayPal has not been able to recover everything, so PayPal is going to take some time. SMCI, in the midst of all this market craziness, this stock is up 500% for the year, $341. And a stock like this being up right now just shows you why Palantir likely kept their premium. It's because if you're an AI company, SMCI did a lot of stuff with AI and chips, you're going to get a premium by the market, especially if you're able to grow. Now, SMCI is growing. Palantir is not growing that much. So the market's betting that they're going to be able to grow in the future. Let's look at Datadog. Datadog is down 18%. I want to take a look at their earnings really quickly and see why this is happening. Then we'll keep going there from there. Dave says, can you repeat what got downgraded? Yes. Moody's is a credit rating agency in the United States of America, and they downgraded 10 U.S. banks. And the reason they downgraded those banks is as follows. I'll read the quote again. U.S. banks continue to contend with interest rates and asset liability management risk with implications for liquidity and capital as the wind down of unconventional monetary policies drain system-wide deposits and higher interest rates depress the value of fixed rate assets. What that means in layman's terms is people are not going to deposit that much money in the banks, so they have a deposit risk. And second of all, higher interest rates means the value of loans on their banks and the fixed rate assets on their banks go down because the rates go up, so they're not valued as much. So the same argument for why banks suck over the past 2 weeks or the past, 4 or 5 months since Silicon Valley Bank collapsed was reiterated today by Moodys. And it's like, thank you, Moodys, for telling us the same thing that we like kind of already knew. And so the market's in a frenzy because of that. And it's like, I don't know why exactly that's something that we need to be sharing, or that's something super, super important. David, thank you for the super chat. Can we all agree that Danhausen and Luigi Premio are some of the most talented, unique Funi wrestlers out there? We can agree on that. I just don't watch wrestling or know who the Funi wrestlers are and have no idea who you're talking about. But yeah, I agree with you, especially because you sent me $14. I really agree that these guys are the best wrestlers out there. So thank you, David, for that. Okay, Datadog's earnings. Datadog earnings for the second quarter were 36 cents per share on an adjusted basis, up 50% per year. The enterprise software maker's revenue jumped 25% to $509 million. Meanwhile, analysts expected Datadog to report a profit of 28 cents, so they missed on EPS. They beat on EPS, which is good, and revenue of 501, so they beat on revenue and EPS. So why are they down? It has to be at the midpoint of guidance that missed. So look at this. Datadog expected 523 million of guidance. Wall Street expected 530. That is a 536. That is a $13 million miss on guidance. $13 million miss on guidance. The stock is down 18%. Why? It's a SaaS company, just like Palantir. $35 billion market cap. Palantir's at $38 billion market cap. Datadog trades at 19 times price to sales. Palantir also trades at 19 times price to sales. Why did Datadog get smashed, destroyed, and hammered by the market, but Palantir didn't? Maybe it's because the market actually believes that Palantir is an AI company and that there's growth built into them, and they're trusting that Palantir will get that growth over something like a Datadog. That might be the reason for why we're seeing this decline. And that's ultimately why we might have got that decline. Cut guidance by a little bit. I'm buying Datadog over Palantir. Yeah, but the guidance cut that they did it by was so small that it was very weird. It was like 13 million cut in guidance is not enough to justify an 18% decline in the stock. I mean, that's a pretty decent decline. So it's very weird that they were able to do that. Thank you to 819 people being here. Thank you for joining me for the market open. If this is your first time, I cover the market 9:20 a.m. to 10 a.m. every market, and hopefully you get to start your day with someone who is able to give you some interesting insights about what's going on in the stock market. Truist continuing to be down $31.12, down 5%. My goodness. Palantir, there you go. There's the red, down $16.40, down 8%. Look, this is what I expected yesterday after earnings. And so the fact that this didn't happen yesterday, it's no surprise that it's happening today. But again, most people even expected a 20-30% decline in Palantir simply because of the fact that the premium is too high. Palantir is still a $34 billion company, price to sales of 17, even being down 8% on the day. And a lot of this 8%, I would argue, is because of this Moodys nonsense. It's not because of Palantir. I mean, look at the left-hand side of my screen. Palantir is not an anomaly here for being down. I don't know if Moodys didn't announce their... If Moodys wasn't moody today, okay? If they weren't going through whatever they're going through, we might see a green market and Palantir might not even be down 8%. So it's very interesting to kind of see what the macro is playing in right now and how it's affecting a lot of different stocks. David, thank you again for the $13.99 super chat. It means a lot to me. What are your favorite cybersecurity stocks? Mine are Crowd, S, and Zscaler. Mine is Crowd. Now, Crowd could arguably be a little expensive. The most about Crowd, I understand the most about their implications within the cybersecurity space. I do not own the stock, but it would have to be CrowdStrike because to me, they are the industry go-to name when it comes to cybersecurity. Now, the others might be cheaper. I actually don't know, but Crowd is the one I would buy if I had to, just because I know that that's a name that most people actually care about. Okay, let's take a look. Oh, by the way, Dan Ives is confirmed. You guys are hearing it first. 851 people are on Twitter. You are or on YouTube. You are hearing it first. Dan Ives DM'd me this on Twitter or X, whatever you want to call it. And he said, let's confirm for Friday at 4:30 p.m. So if you are not on Twitter, the Twitter is in the description. I'm going to put the Twitter in the chat. Make sure you're on Twitter. This is only going to be on Twitter Spaces, and we will be doing it from 4:30 or 5 p.m. on Friday. He's in Europe, so he'll let me know what time. We'll be doing the Twitter Spaces with Dan Ives. It's going to be super exciting. Going to be asking him everything he thinks about Palantir. The other thing that's also really interesting about it is that he was able to ask Palantir a question yesterday. Palantir now down 8.5%. they allowed him to ask a question, which is really interesting. I did not know that Palantir, they were very selective with like the analysts they allowed to ask a question. They allowed Dan Ives to be on the earnings call and ask a question if you watch the earnings replay. And Dan Ives' question was actually really good. He was like, why are you seeing the interest in AIP? And so the report makes a lot of sense now that I think about it. He upgraded them to $25 off the conversation and called them the messy AI of all these different CIOs that are saying, look, the only reference point we have is Palantir. Then on the call yesterday, Palantir is telling me they have over 400 clients that are likely going to be using AIP within the next 2 years. And so you've got Dan Ives, it's Eastern time zone, Astrocus, Eastern time zone. 5 p.m. Eastern time zone on this Friday. You've got Dan Ives saying, look, everyone I talk to is using Palantir's AIP, or they're thinking of using Palantir's AIP. You've got Palantir saying, hey, we haven't closed these customers, but we're literally talking to 400 of them. 100 out of the 400 are already in the like pipeline, like as in they're using the product. When it comes to AIP, Dan is probably thinking, that's 400 new customers that you're going to be able to generate AI revenue from. If the AI market is expanding, and you have freaking pricing power over that. And then that leads to a tailwind and a compounder of more clients you're going to be able to get in the future. Well, then it's a no-brainer to call you guys the Messi of AI. And I think that's why he didn't care about the valuation model that much. He just cared about really getting it out there and saying that Palantir is going to be the top dogs doing this thing. So that's why I think they also allowed him to ask a question on the earnings call. Them allowing him to ask a question on the earnings call made sense given he understood what was going on with the company. And so we're going to be able to talk to him 4:30 p.m. on Twitter Friday. Please make sure to follow in the description. It'll be a really exciting spaces, and I hope to see everyone there. It'll be fun to see what he has to say. Amit, did you trim your Palantir position a little bit to protect your gains or sell any covered calls? I did not. I did not sell any of my Palantir. My simple logic is not that it's bad to sell and take some profits. Palantir down now about 9% at $16.36. My logic is that I can't time it. I've tried this with many stocks many times before. I can't do it. I've failed at it. I'm not that smart at price directionality. Unless I buy long dated leaps for options, I don't want to speculate on price. I just want to buy and I just want to hold. And part of being an investor is living with the volatility. So for me, my average is 15. My average is not amazing. So if it falls below 15, I'm actually fine and happy to pick up. But selling at 20 and pocketing, whatever gain I had, it's like, and trying to time it, it's just tough. It's just very tough to do that. And so I'd rather not. TJ, the Wheel Deal, $10 super chat. Thank you. Celebrating 10 million in career premiums collected. I took a beginner-friendly strategy, treated it like a business, and learned how to manufacture the win. Here's to blue skies and green stocks. That's pretty amazing. TJ, for those that don't know, trades options and trades the wheel. And so he sells cash secured puts, which is just a way of being able to set a strike price where you're comfortable actually owning the stock. If the stock doesn't get there, you get a premium from the market. And that premium from the market, he has collected $10 million of that premium. So awesome stuff, TJ. Happy for you. Why is it going down? Well, again, the reason it's going down is because look at the left-hand side of my screen again. General macro is shit today. What are the green stocks? You've got Disney that's flat. Disney that's up 0.02%. You've got AMC. Oh, AMC actually had a decent earnings. I want to talk about them. AMC is up 1.5% and Lyft is up 0.068%. That's what's green today. And then Apple at 178, it's up 0.04. Everything else is red. SQQQ, short QQQ, is up 3% today. So I think the main reason it's down is because of the macro, down 9.6%. Maybe earnings decline as well, but earnings decline might have been 2, 3, 4%. I don't know if it would have been 10%, but the left-hand side of my screen is kind of showing that it's a little bit worse. Now, imagine if it tanked yesterday 20%, and then on top of that today, you get the Moodys bank decline, which the whole market has to take a shit. This would be down a lot more. So the fact that it's at 1622, not too bad for me. Let's see where's the floor. Let's see where's the floor. Let's also talk about the $1 billion share buyback that management authorized. I want to have a discussion on that. I want to know in the chat. Thank you, 973 people, for being here. I really, really appreciate it. What is your thoughts on the I sound like Carp right now. The $1 billion share buyback. I have a couple of unique thoughts on this. Now, here's what the bears are saying. Why didn't Palantir do the $1 billion share buyback when it was $6, $7, $8? And when you think about that argument on a surface level, especially if you've been a long-term investor, you kind of agree with it, right? Because you're like, look, our stock was pretty cheap at a certain price at $6, $7, $8. Why weren't we buying back shares? We all knew how cheap it was. It would have made sense to buy back shares and ultimately be able to, not dilute shareholders that much and get a great return on some of the equity, given we were back so cheap. The problem with that argument, to me, the way I've been analyzing it, and I would love to know what people think in the chat as well. Big Eyes Gallagher, good morning from Seattle. Thank you for being here. Really appreciate you being here. 1 billion puts a floor on the stock. Exactly what Heinz said right now. So the $1 billion of share buyback, which is 33% of the cash we have on the balance sheet, This makes sense to me right now because imagine buying the stock when it was $6, $7, $8. We were not gap profitable. We had excessive amounts of stock-based compensation. Carp was saying that we're not going to be profitable until 2025, right? So the projections in terms of the overall outlook on the company were really shitty. I mean, to not be public 5 years until after you go, well, we're not Spotify. We should be able to make a profit or freaking not being 10 years on the market and not being profitable. So we're not Snapchat, right? We should be a profitable company. So the outlooks on the company from $6 to $8, given the fiscal responsibility or lack of responsibility the management was showing in terms of stock-based compensation and lack of profitability, and overall not great revenue growth, could have been seen as using shareholder capital and burning it to be able to to buy back shares when it's cheap. Yes, it is cheap, but the future of the business was uncertain. So I think management actually authorizing a share buyback when the stock has gotten a floor to it in terms of getting some level of support and also being recognized for the company. It should be recognized as like a legitimate AI company, not just a company that's just down in the gutter, and now being gap profitable, having stock-based compensation normalized. That's actually a much better reason to now initiate a $1 billion share buyback, at least for management to appropriate it. And one of us that was in the live stream yesterday, who's been in data analytics for the past 20 years, he's a very long-term investor in Palantir. His argument was like, I would have hated if they were buying back shares at $7, $8 because the business is uncertain. You have to get the business to a point where I feel that you are certain and you have a trajectory that is not literally action, like you're not trying to survive. You're actually a thriving business at this point, and now it's just a question of growth before you buy back your shares and use shareholder capital to actually buy back the stock. So the $1 billion in stock buybacks, that's not saying that it's that's authorized. That's not saying that they have to use it right now. That's saying that they have time to use it. They might use it when it drops to 14, 13. We don't know when they're going to use it, but that does mean they are confident in their business to bet on themselves, which is exactly what Alex Karp said today, that we are more confident to bet on ourselves, not to just acquire other companies, which is another reason why they ultimately were able to issue these share buybacks. Now we are down 9.95%. We are likely going to be down 10% in a little bit. Palantir at $16.20. There we were down 10% just for a little bit. Datadog down 16%. PayPal down 1%. Truist down 5%. S&P down 0.85%. Tesla down 2%. The entire market is absolutely bloody today. It is a red market. One more thing on the buybacks. If the AI quote unquote bubble is existing, and we know Palantir is going to be at an average of 14 to 18 bucks for the next couple of quarters, whatever it may be, and we don't get those $6, $7 prices again, then that's why management probably had to issue a share buyback because now there's a floor, right? If the AI bubble lasts for a longer time, over the next 5 years, if 16 bucks was actually very cheap for Palantir, right now people think it's expensive. What if in the next 5 years it's cheap? Then management might be taking a bet on themselves that they believe their stock is actually undervalued and they're going to grow into their valuation and massively exceed the growth of their valuation. So it's a good sign from management basically showing confidence in themselves as a company and doing something with the capital they have on the balance sheet, which is not diluting shareholders and buying some more of that stock. You get that money right back as EPS, so it's no different. That's also true. So if they have a bad quarter in the future, they'll be able to do what Google, Microsoft, Amazon, Apple do, which is financially engineer the results. And Apple, goodness gracious, Apple, the amount of times Apple has had a shitty quarter over the past 6 years, and they bought back $20 billion of shares just to make sure that their EPS comes in line with expectations. Because again, it's hard to grow Apple. Apple's a really big company right now. So they have to do this financial engineering. Palantir is doing nothing that they aren't doing, and Palantir might be doing it in an effective way for them as well. So that's actually not the worst thing here. It looks like Palantir is testing support on the 50-day around 1611. That is true. Rivian had earnings. Lucid had earnings as well. Let me go to Rivian earnings. I think Rivian, did they have earnings? Rivian is down 2%. Let me know in the chat. I actually don't know if Rivian had earnings, but they are down 2% on the day. So if they did, that's not a horrible decline. Lucid is down 1%. The Saudis are keeping Lucid alive. I don't think their earnings were good yesterday from what I understood in terms of deliveries and vehicles, and the comparison to Tesla kind of sounds like a joke at this point. But the Saudis are continuing to pump money. What is their market cap? Lucid's market cap is 14 billion. Wow. And I think they deliver 8,000 cars. So, well, yeah, I don't know who's long Lucid, but if you're long Lucid, there you go. You're at least not down too bad. Cross the negative 10%. Yup, it was down 10% as well. Palantir to buy back shares to make sure they are gap profitable. I mean, I don't know. I don't think they're going to have to buy back shares in Q3 to remain gap profitable. Oh, here's the other catalyst that is big on Palantir. This is another reason the market might be not absolutely destroying it, is S&P 500. Look, we're getting into the S&P 500. Management literally said yesterday, it's going to happen, right? They were basically just saying, like, we're going to be GAAP profitable. We will be eligible. It's going to happen. And so when Palantir is included in the top 500 companies in the United States of America that institutional investors will have to have exposure to, I don't know if that like pops the stock huge, but that does create another reason for stability for a company that has not been stable over the past years, because now you've got institutions that have to own it. They've got to own it. And so it's going to be exciting for them to get access to that. We also have the NHS contract coming up, presumably in a month. So we should be knowing if Palantir gets this NHS deal, and we'll kind of see how that plays out from there. Let's take a bit of a bearish look on the market. Here's someone who says we expect a correction or a recession later this year or early 2024. Let's take a look at their perspective.
Avoid big tech and focus instead on international stocks. For more on the markets, let's bring in Jeff Klingelhofer, the co-head of investments and portfolio manager at Thornburg Investment Management, which has about $42 billion in assets under management. Jeff, great to have you with us. We were just talking about yesterday's market action. What was so notable about that big gaining yesterday? That was on the back of a decline in Apple, a flat performance in Microsoft. So the big cap tech stocks continue to sort of sit on the sidelines here. Is that why you've gotten a little bit more cautious on this rally?
I think a lot of things, right? We're watching the consumer weaken. We're watching really just the economic cycle play out almost exactly how you would expect it, just over a lengthened time frame. On the back of that, we've seen positive earnings thus far. We've been surprised at the resilience of companies' ability to pass through those increased prices to the end consumer and their ability to support them. But as stocks have rallied, we've pulled back a little bit as we still expect a recession in either the late part of this year or probably more likely the early part of 2024.
Mm-hmm. I'm sure you saw the Moodys downgrade of U.S. banks this morning, and they highlighted sort of what the second quarter results showed in terms of the quality of the asset book they have, but also the headwinds that they could see even more with the commercial real estate portfolio, especially as we head into what they expect a mild recession in 2024. Do you agree with this call? Do you think that's a source of concern for these markets?
I mean, as always, it's a little bit on the late side, right? But we've been watching this for quite some time, but it's 100% accurate in the sense that as the economy continues to shrink and everyone knows about the challenges within the commercial real estate side, it is going to be a challenge, especially for the smaller size banks. But on the flip side of that, what we've seen through this earnings season is as the consumer continues to hang in, many of the large banks are actually outperforming. Mm-hmm. Provisions for losses continue to be a little bit lower than we would have expected. And you're really setting a dichotomy up between the smaller banks within the U.S. versus the larger banks within the U.S. So we continue to focus on the more defensive sides of the banking sector and prefer to play the large money sector places.
Do you think that the most of the troubles within the smaller to mid-sized cap banks, the ones that were really the focus of this downgrade, we've seen the worst of it, or do you think that's another shoe to drop?
I think there may be another shoe to drop just as we continue to see the realized challenges come into the CRE space. But I think many investors have already expected it. So maybe from a sentiment perspective, I would suggest that we're past the worst of it. From a downgrade perspective, there's probably a little bit more to come.
So what triggers the consumer to actually fall out of bed? I mean, we've seen the consumer.
So this is a good question. He's basically going to answer why the consumer would lose confidence and why if we lose the consumer, then earnings are not going to be good in Q3.
Hang in, even though inflation's high. Inflation's starting to roll over now. So what is it at this point?
I'd say it's not so much inflation. We have to look through that one level deeper, right? As we've seen the consumer, it's been incredibly, incredibly strong. One thing we're watching in particular is that roll rate from 30 days delinquent to 60 days delinquent. That's the transition from, gosh, I forgot to make a payment on my credit card to I can't make a payment on my credit card. So we're watching the latter half of this year. Again, companies have had an incredible resiliency, the ability to.
Okay, so that was his argument. His argument, and thank you to the 1,000 people that are here. His argument for why we're seeing this recession that's likely going to happen, in the words of, his firm and how he's representing it to clients, is that the consumer right now might miss a payment on a credit card, but with credit tightening, and I think credit card debt yesterday hit a either like 10-year high or 20-year high at $1 trillion, something like that. I have to get the exact number. I'll look it up in a second. They're going to go from not being able to make their credit card payments to forgetting to make their payments, to literally not being able to do that. There's some truth to that in the context of a couple of macro things I'm looking at. Number one is student loans. I have $10,000 in student loans left, so I'm gonna have to start paying $250 a month or $300 a month, whatever it is. And that $10,000, that $200, $300 a month, I can't spend in the economy, right? I can't spend in other things, so I have to pay for that. If credit tightening is getting to its highest of levels that we've seen in a while, and consumers are just going to default, i.e. they're going to be delinquent on their obligations, that's not good for the banks. And if that's not good for the banks, that's definitely not good for big tech, because the reason Apple and Amazon still had a phenomenal earnings was because the consumer is buying iPhones, buying iMacs, buying Apple Watches, even though Apple Watches are incredibly overpriced in my opinion, and buying shit from Amazon. And so as a result of that, we have not lost the consumer, which was his point. If we lose the consumer, we lose everything. Now, what is the reason for why we don't lose the consumer? Because a lot of the bears want to make arguments for why, everything is going to go to shit and that this is going to get really bad. Palantir recovering a little bit now, down 8%. It was down 10%. So it seemed like 10% was a little bit of the floor. We'll see how far it goes from there. But now down 8%. What is the reason for why we don't lose the consumer? So there's two reasons. Number one, inflation is coming down, and we're going to get inflation in a couple of days. If we don't have a 3 handle on it, meaning we have a 2 handle, like a 2.9, 2.8, maybe we have 3.1, 3.2. By the end of December, we're likely going to have inflation at 2.7 or something like that, right? We will have inflation under 3%, which means the Fed is going to have to make a really strong decision to basically decide not to raise rates. And when we will cut, I don't know. But as long as we don't raise, that is a net good thing for the economy. So if inflation is going down, the consumer has more pricing power and more ability to buy different goods and services. The second thing is that wage inflation is outpacing general inflation. Wage growth was up 4.4%. Inflation was at 3%. So if wage growth is higher and we have a phenomenal labor market, we are not seeing the massive levels of layoffs there. And maybe that'll happen. But as of now, if you look at every jobs report, we are beating on every expectation. The labor market is tight. There is a shortage of jobs that are or a shortage of jobs versus more demand versus supply for those jobs. And so that could still create a resilient consumer, even with more credit card debt and student loans coming into place. If that's the case, we might be able to architect this soft landing that Jerome Powell was talking about and not have some massive decline. And if that's the case, then that would be a really good thing as well. And so it's going to be interesting to see where it kind of goes from there. Credit card debt always goes up with money supply always going up. Dumb statistic. Oh, wow. See, I didn't even know that. Philip, that's a great comment. I did not know credit card debt always goes up with money supply. That's an actually good stat. That makes a lot of sense. When M2 supply goes up, of course, credit card debt is going to go up. So I have to go a little bit more deeper into it. But yeah, so I mean, a lot of the bears, remember, a lot of the bears on CNBC, they missed out on the rally. The market's up 20% year to date. Now it's up like 17%. They missed out. And so if they missed out, they would love to get the S&P back at 4,000. And I think it's possible. We could see a 10% correction, which is put the S&P at 4,000. But the question then becomes, are you going to put your money in a 3-year T-bond? Right? Or a 3-month T-bond, or are you going to put it in the S&P at 4,000 with companies still reporting amazing earnings? Are you going to put your money in Google at $100 if it gets back to $100, or Amazon at $100? Or are you going to put your money in the fucking T-bonds? Like, at some level, it's going to be very evident that if we see a correction, the correction is going to be so stupid. If Robinhood gets to $8 and has $6 billion in cash and a $6 billion market cap, that equities are going to be bought up. As long as there is no crazy macro catalyst like a Silicon Valley Bank or a pandemic or anything, it would make sense to buy equities at that point. Daniel says, can you explain what hedging is? Is it like shorting a stock you're invested in as insurance if it goes down? That's correct. And instead of shorting, it's more so buying puts. Shorting, your max loss can be infinite theoretically, whereas on a put, if I hedge my position, if I bought, $14 puts on Palantir, that means if Palantir goes to $14 because they have a bad earnings, those puts will make me money because I took a strategic bet that the company would drop to $14. And so I'm rewarded for that. So even though I lose value in the actual position I have going from 18 to 14, I make money on the puts, which hedges my position and narrows my loss. If not, completely washes out my loss. And that's what hedging looks like. I don't really buy puts. I don't hedge my position that much. Kind of just go long and see what happens overall. Reason for labor shortage is our demographic decline, something rarely referred to. This is actually a really good point, Alton. This is a great point. A reason for a labor shortage might be that our demographics are declining. I haven't looked at the United States demographics over the past couple of months, but if that is in decline, which we know people don't want to have babies anymore because for some reason climate change means don't have babies. That's the existing narrative. Then that actually is that's a contrarian point that hasn't been brought up a lot. That's actually a great argument, Alton. I definitely want to go deeper on why we might be seeing that. Are you still in TFC? Yes. My positions. Let me update you on my portfolio. I am in all my stocks. I am not out of everything. I am in PayPal option spreads, call debit spreads, SoFi call debit spreads, Robinhood call debit spreads, TFC call debit spreads, and of course, I am in all my positions. My positions are not down. I will say, just a week ago, my portfolio, the swing in my portfolio from last week when SoFi reported earnings to today, it's It's a lot, bro. It's a lot. And it's to the downside. But that means it was to the upside on SoFi earnings because SoFi had great, and I have a very big position on SoFi. Like I don't even want to. It's insane. Like it's insane. But this is what it means to be long term, and this is what it also means to have a thesis. And I have options that are long term, January 2025. If I think by 2024 we're in a shit show, I'll sell out of them. I'll get out of them. I do not think we're in for a shit show in 2024. I really don't. I could be wrong about this. And if I'm wrong about this, I will take my narrow loss or I will break even by the end of 2023. But if inflation's coming down and earnings for big tech and all these companies have been fine, even Mike Wilson, one of the biggest bears on Wall Street on Morgan Stanley that made his clients miss out on a 20% rally and has gotten a lot of shit for it, even he says we're going to go down like this on the S&P, 10%, and then we're going to go right back up, and S&P will be trading at $230 earnings per share in 2030, which is about a 4,800 price target on the S&P. But he thinks we're going to 4,000 first. So even he says, look, it's going to go like boop and then boop right back up. And once it goes down to 4,000, Mike Wilson, who missed the rally from 360 to 4,500, he will buy at 4,000 because he will not justify to his clients not buying at 4,000. And basically that's what he said he's going to do. But it's a question of if we get that short-term correction, and maybe September, October, we get that short-form correction. And so we're going to see if it happens. You're going to sell your positions if we forecast a recession, not if we forecast a recession. If I have the conviction that a recession is happening, then yeah. Like if I personally believe that holy shit, 2024 is going to shit, yeah, I'm going to get out of my positions because they're options, and those options, they're not just stock, right? I can't just hold them forever. So I have to be strategic with them. But I don't think that's happening right now with all the macro data I'm looking at. I really don't think 2024, and also 2024 is an election year. Look, Joe Biden's going to make sure 2024 we are okay. All right. Oil prices are going to be okay. And maybe this is more naivete on my sense, but looking historically at what happens on an election year, you don't see the market go to shit. The reason it happened in 2020 was because of the pandemic. And then during the pandemic, it went back up. Like Trump actually had a good shot of winning because the market rallied massively from March 2020 to November 2020. So I don't know. I just don't see that many macro effects in place for us to have some horrible recession, but we'll see what happens. Maybe it is, maybe there is some bad stuff happening. He will not sell Palantir. Yes. That's the one that I'm just keeping for a long time. So not going to be selling that. Imnop says, if you have a lot of money, you don't keep it all in the stock market for security, diversify. Yeah, I mean, look, it depends on where people, put their money. Obviously, real estate, there's a bunch of different assets, but I think a lot of people are going to be fleeing to different names, potentially, value stocks, more cyclicals, instead of growth companies. Oil may be getting a little bit of push. Energy, different stocks like Home Depot, right? These like kind of staple blue chip stocks, they may be getting a little bit more of a premium as we rotate. But the question is, how long does that rotation happen? If that rotation doesn't last for a long time, then I don't think there's going to be some massive decline in the market. So again, you got to remember, these are phenomenal companies. And don't forget, there is a fourth industrial revolution happening right now when it comes to artificial intelligence. I know that sounds cheesy, but if you're in the space and you're deep in seeing what's going on in the market and overall in tech, this is a real big thing that's happening, and that will reflect in valuations. Microsoft, right, being able to gain $80 billion in market cap because they introduced Copilot that 400 million people could be using on Excel and PowerPoint. That's an AI-powered assistant. Like, that is just the tip of the iceberg for where AI is going. And so same thing with Tesla. Like, these are companies you want to be invested in over the long term. And so I don't think that the market's going to choose bonds over them going into 2024 unless we see some massive macro catalysts. And if we do, we'll see what it happens. If not, then we'll go in a different place. Healthcare, that's another sector that could benefit as well. Okay, so that is it for me. Thank you all for being here. 917 people. Thank you all for being here. Again, these Twitter Spaces with Dan Ives will be at 4:30 p.m. on Friday. If you are not following on Twitter, the Twitter is in the description. Please make sure to follow. You'll be notified. 4:30 p.m. on Friday, we will be discussing Palantir with Dan Ives. I'm taking a last look at the stock. Palantir is at $16.70 right now, so it's down 7%. It was down 10% at one point, so recovering just slightly, but overall a pretty red day for the market. This is one of those days where you just want to go do something else. Don't look at your portfolio. Go focus on other things in life because there's many other things to focus on. It's a red day. It's going to be a red day. Might be a red week. Moodys was in a bad mood, gave the market a red day. We should be fine over the next couple of days, hopefully the next couple of months, and it's not as crazy to worry about. So that's it. That's it for me. Please like the stream. Please subscribe if you enjoyed the content. And that's it for me. I will see you guys tomorrow, and I'll have a Palantir earnings recap video coming out a little bit later today. Thank you so much for joining. Really appreciate it. Good night, everyone. Have a great day. Bye-bye.